Hey soldiers, the Fed, large corporations, and the government in general, once you broke, busted, and disgusted, they've got a problem with the fact that Americans have quite a lot of money saved.
He ain't lying.
And they want that money spent. But there are some issues in the way of that. Let's get right into it. This is our second video of the day. I had to do two today, guys, because things are happening so fast, okay, that I just want to get it out there. This is from the Wall Street Journal. Cash-rich consumers could mean higher interest rates for longer. Now, by the time you watch this video, Jerome Powell will have increased the interest rates once again. I'm going to show you how I can confidently make that prediction. And guess what? This video goes up whether or not I'm right. If I'm wrong, won't be the first time. Won't be the last. Buoyed by pandemic-fueled savings, consumers and businesses are proving less sensitive to tighter credit, complicating the Fed's job. Washington's response to the pandemic left households and businesses in an unusually strong position financially, with higher savings buffers and lower interest expenses. It could also make the Federal Reserve's job of taming inflation more difficult. So right there, they're saying that the Fed's mission is at odds with you having an economic environment that's more advantageous to you building wealth. Low interest rates, that's going to help you build wealth, right? You want to go out there and take out that business loan. Low rates would certainly help with that, right? And having more cash on hand to provide an emergency/opportunity fund to start putting away in terms of purchasing assets. Wouldn't that be great for you and your family and your wealth? Yes, it would be. But apparently it's not good for the U.S. Central Bank, which is trying to slow down economic growth to prevent inflation from becoming entrenched. Now, I understand the macroeconomic principle here of, all this money being on the street, so it's driving up prices because you've got more money in search of fewer goods. I get that, okay? I also think that when the Democrats come out and they start crowing about, well, you're going to be putting people out of jobs if you raise interest rates. This does two things. It shows you the ignorance of the American politician and then the electorate that put them in there, the economic ignorance, because they know full well, they should, that when you have a situation where Congress went and collaborated with the president, Trump and Biden, and created a lot of additional monies, okay, Republicans and Democrats, they know, or should, that that's going to cause inflation, especially to the tune that they did it. So you got the people that know and that should know, okay? And now what they're doing is they're just using it as a political kind of cudgel because, come on, Congress controls the fiscal policy. And you can drag this all the way back and lay it at the feet of governors throughout the nation who had the bright idea to slam the brakes on a multi-trillion-dollar economy. And it hasn't been right since, okay? So these politicians, that's why they all need to go, because they don't know what they're doing, okay? Their ambitions are getting in the way of sound economic policy. And that adds pressure to the Fed's job of manipulating the monetary policy. Now, look, I'm not here to, in this video, we're not arguing the merits of whether or not a Federal Reserve Bank should exist. We can do that down the road. And right now, we're just dealing with what is the reality of the situation on the ground. All right, so we think the Fed is going to raise by another 75 basis points, bring it up to around 4% in terms of the interest rate. Some officials have argued for slowing the pace of rate rises after this week's meeting. But I'm going to show you how the Fed's going to say, they're going to say we don't have to do that because the data says otherwise. Now, go back and watch the video we did just before this one today, where we are showing you how the Bureau of Economic Analysis manipulated the GDP number to make it appear higher. So the Fed is going to take a look at that number and they're going to run with that. And they're going to say the economy is doing fine. In fact, that growth rate is such that we can afford to slow it down. When in fact, go watch the video. We show you how they they intentionally manipulated the calculation to make it look a lot better than it was probably for the election that's coming up. They won't be saved by that. Now, here's the thing with the money that is floating around out there. Household, non-financial, corporate, and small business sectors ran a surplus of total income over total spending equal to 1.1% of gross domestic product in the quarter April to June of 2022. And this is according to economists over at Goldman Sachs. Using a 3-year average, the measure is healthier than on the eve of any U.S. recession since the 1950s. Now, again, that I'd like to see the figures in a recession as we're maybe coming out of one. Maybe these numbers look a little different because, as we explained in the video prior to this one, we certainly are in a recession. And we explain that in great length using the United States' own data. All right, listen to this. This is literally a money shot. U.S. households still have around $1.7 trillion in savings that they accumulated through mid-2021, above and beyond what they would have saved if income and spending had grown in line with the pre-pandemic economy. This according to estimates by the Fed. Around $350 billion in excess savings as of June were held by the lower half of the income distribution, or around $5,500 per household on average. And they want that back from you. So the way they intend to get it is by twofold, by raising interest rates, and that's going to have an effect eventually on employment. And so when you lose your job, you'll have to spend the $5,500 in order to survive. Okay, so that's why this is being done in the way that it's being done to bring down inflation, but it's going to have one hell of an effect on the average American. All right, now let me show you real quick how this is also going to, this is a series of dominoes falling. Businesses were able to lock in lower borrowing costs as interest rates plumbed new lows in 2020 and 2021. Just 3% of junk bonds, or those issued by companies without investment grade ratings, mature over the next year, and only 8% come due before 2025, according to Goldman Sachs. Also, to the extent businesses have to spend more to borrow money to run their operations, of course, cost is passed on to us, the consumer. Now here's the triple whammy. State and local governments right now are flush with cash, leaving them in far better positions than after the recession of 2007 to 2009. Now, as unemployment becomes a problem, as the housing market slows down, we will see local and state governments' tax revenues slow down. And so when that happens, these surpluses will be eaten into, just like on a personal level with the $5,500 we talked about. And that amount of money, that's for the lower strata in terms of the socioeconomic scale. So poor people were able to get a leg up, okay? Middle class folks were able to get, out of a situation where they were living absolute paycheck to paycheck for a minute, although most still are right now because Americans don't know the difference between being a profligate spender and an asset acquirer, unfortunately. But that's the triple whammy. So it's going to hit you, it's going to hit businesses, and then it's going to hit your local and state governments, okay? And you'll see higher taxation, quite possibly, especially in the liberal states. Boy, they love to tax. They like to tax you in good times. So if times get hard, you know exactly what they're going to do. Now, look, let's look at another metric. So we already talked about the GDP number, the fake, phony, manipulated GDP number that the Fed is going to definitely use as fodder for another interest rate hike. But he's also going to, when I say he, I'm talking about Jerome Powell and his, assorted minions. He's also going to use this. U.S. job openings rose in September in a still tight labor market. Demand for workers remains elevated, with job postings far outpacing the number of unemployed people looking for work. So let's see here. Job openings rose in September from the prior month. In a still tight labor market, we're looking at an increase in openings and other figures in the Labor Department's report on hiring, demand, and job turnover. So basically, in a nutshell, what this is telling the Fed is, hey, job market is still hot. There's still opportunities out there, okay? Which, hey, I'm not complaining about that, right? We don't knock hustles. So if you need a job, there seem to be jobs out there. Now, of course, if your skill is coding and there are truck driver jobs available, you might not be qualified. So we're just talking very broad, 30,000 foot type stuff. But on the whole, according to this data, jobs are plentiful, okay? Employers' total job openings increased 437,000 to a seasonally adjusted 10.7 million in September from an upwardly revised 10.3 million openings the prior month. So it would seem that there are literally millions of jobs available. All right, so what he's going to be looking at is the month-over-month number. From August to September, 500,000 jobs became available. That's a lot of jobs. Now, again, some of those jobs pay $250,000. I'm sure some of those jobs pay $20,000. But Jerome Powell has got his eye on the fact that the amount of jobs available is increasing. That is going to give people choice. If they got one of those $20,000 jobs, it's quite possible they could now move to a $40,000 job and still have more money available and then be able to, mix it up and fight inflation a little bit better. He's going to be looking at that. So you can bet your bottom dollar. Don't bet your bottom dollar, but I'll bet you a cup of coffee that interest rate's going up, and it ain't going to be the last time that happens. There are going to be 2 more interest rate hikes, including the one today, so 1 more after this one, that are going to occur in 2022 unless something absolutely drastic happens. All right, guys? So go ahead, watch that video we just did talking about why the GDP number is fake, phony. They are bamboozling you, and you'll learn why in that video. All right, guys, I will talk to you soon.